Morning, JP.
Morning, Brandon.
So we're back at it, creating another video, and I
Mhm.
wanted to just say a couple things before we get started.
Sure.
We make these videos because we can't talk to our clients all the time, but we do notice patterns when they call and some of the things that we're hearing from them, and we like to address those. Of course, our lines are always open for them, but it's nice to be able to have some touch points like this.
Mhm.
One of the things we're hearing from our clients is, boy, the market's up. It's so hot. It doesn't make any sense. It can't go on forever like this. And I think in a way that's true, but in many ways it's not. And I wanted to address that today in today's conversation.
Yeah, I think that's correct. Coming out of 2022, it feels strange because I think we all know that last year was a down market. It was the first down market we had that wasn't tied to some kind of global event, right? So we all remember the pandemic slide, but then things rose pretty quickly out of that. And it's been pretty smooth sailing since then. And so seeing the market up after a year like last year, it feels strange because we're not actually to where we were before we started 2022.
Yeah, and where we're talking about benchmarks, and benchmarks are a really interesting thing right now. Traditionally, asset managers like ourselves, investment managers, are compared to a benchmark like the S&P. But the S&P is pretty funky right now by the way that it's designed. And this year, the S&P is up. What's today? Today's the 13th of October. So it's up about 12 or 14%. But that 12 or 14% can pretty much be attributed to four companies.
Right.
Amazon, Apple, Microsoft, and NVIDIA. We hold some of those companies, but never in a million years would we say, hey, here's a portfolio. We did our job. We bought four portfolios. That's not risk management. That moves towards gambling, really, right? Or speculation.
Mm-hmm.
And so there's actually, the S&P has a little more than 500 companies. So you take all the other companies minus those four, and they wash out to have about a 1% return, right? So the market doesn't, it has, we say, bad breath. Like, yeah, there's a couple companies that in the US large cap index that are doing really well, four of them, and driving outsized returns by the way that they're calculated.
Yeah, absolutely. You can think about like NASCAR, right? When you have a race, you have all of your cars together, and then at some point they start to pull apart, right? And you can have races where one or two guys are way in the front, and you can have races where everyone's close. And right now we have a race where there's only a few cars out front, and everyone else is either crashed or is lagging behind.
I love that analogy. And that's why I love that we don't really script these things out, because I had no idea that was coming to me. Yeah, it's like NASCAR. What I also wanted to say about that, what were we, you threw me with the NASDAQ or with the NASCAR. Four companies leading the way. Yes. So let's just say you were like, you know what, 3 years ago, I was going to have the foresight to invest in these four companies.
Right.
And now this isn't exact science. We've done the math, but these things change. So it's not like to a T on the exact percentage. But last year, those four companies would have been down about 36%. Right? That's a really big loss. And then the year before that, they were up 1%, 1.14%. So even if you had the foresight to say, I'm just going to speculate, I'm going to bet on black, I'm going to bet on these four, it wouldn't have worked out too well for you. And so what we're seeing is, yes, the top line numbers, the headline numbers of the stock markets look like they're doing very well. But there are challenges within these companies. And that's why we don't just buy all 500 companies, why we pick companies that we like, we know what we own, why we own it. That's our strategy. At times we do buy the whole market. But in essence, we really want to know what we own.
Yeah, absolutely.
And I know you put together some charts on this, showing some, and we've been looking at those. So do you want to show, kind of illustrate kind of the breadth of the market and what's been happening?
Yeah, absolutely. All right, let me know if you can see this.
I can see it.
Wonderful. So what we have here is three different benchmarks, like Brandon said. These are large indexes that you can use to track different strategies. So what you can see is we have the equal weight ETF. So those same 500 companies, but we don't say one is worth more than the other. We just took a blanket amount of money and we spread it evenly across all 500 companies. So imagine you put a dollar into all 500 stocks. We then have the S&P 500, very classic US benchmark, and that is going to be cap weighted. So the bigger the company, the higher investment into that company, right? So if we think of Apple as being the biggest company in the US, it's going to have the largest weighting. Then we look at something like the NASDAQ. The NASDAQ is about 100 companies, and it is mostly technology, right? So it's considered kind of the growth index, if you want to think about it that way. But when you look into the components, really about 10 companies or 10 tickers make up half of the weight, right? So if you have 100 companies, it means 90 companies in that index make up 50% in aggregate, and the other 50% is made up of just whoever the top large tech company is at that time. And Brandon mentioned a few of those names. And you can see if we're looking year to date, right, like Brandon said, if you bet on black, if you had the foresight, you could have made a lot of money this year by putting it really into that NASDAQ, concentrating in those positions. And if you were to do something, more balanced or a classical like the S&P, or even just weighting it equally, you would have had a pretty substantial drop off, right? And we're not advocating one style or another. We believe in having a classic portfolio where you pick companies, you try to make sure that you have enough in certain sectors, and we have rules. But really, if you're just trying to say, I want to pick one strategy and stick with it, you could have 3 very different outcomes. Now, one thing that's crazy is you may say, wow, well, obviously I just need to go bet on that. Well, if we zoom out and we say, okay, well, over the last 3 years, we've had, a big up market in 2021, we had a down market in 2022, and now we're having some kind of rally in 23. You can see that these same indexes actually have a very different outlook, where when you have a large market breadth, you have that NASCAR race where everything is very tight together. Companies are moving forward in the same direction. You actually see that the best performer was actually RSP over this rolling 3 years, pretty much tied with the S&P 500. And then NASDAQ, you can see those large swings. And we're finally starting to see an uplift in 2023, trying to get back to its highs.
Yeah. So bottom lining this is that we're not recommending that people just go out and invest in one index or the other, but we're illustrating that these indexes are not equal weighted, or the NASDAQ and the S&P aren't. And so they don't reflect what's really going on in the market. We always know that the stock market is not the economy. But
Right.
Now the way that these are weighted, and some of these companies have gained so much size, particularly NVIDIA of late, or Microsoft or Apple or Amazon, what we're seeing is that it's even more apart from what the actual economy is doing. And that when we look at the underlying companies, it's good news, bad news. The good news is that they are reflecting some of the difficulties that are in the economy. And the bad news is that they might not be up as much as we'd want them to.
Right.
And so at any time, anything can upset a market, and it doesn't have to be economic. It could be a geopolitical risk. And to some extent, we can't control those. But the fear, I'd say my fear that this market is overheated based on fundamentals is a little bit less than if I just read the headlines, right? The headlines the headlines make it look like it's a lot more overblown than it is.
Yeah, agreed. And then, because I put it together, one other chart just to illustrate, really where we are is if you were to look at the benchmarks and try to have some perspective about where we are and what we've, really looked at the last year, almost 2 years. If we look at the high, just looking towards January of 2022, all 3 of these benchmarks are down at least, 5% plus, 5 to 10%. So even though we've had a good year on paper, if you were just to hold an index, we're still off the highs, and we're still not back to where we were at the beginning of 2022. And, we don't have crystal balls. So one thing that's really important is looking at a 3-year chart, staying invested, having a plan, and sticking to it, because any of these 3 strategies would have rewarded you over that time. And it's all about feeling comfortable with what you own through that process.
Yeah, and we're also seeing some really interesting things in the bond market.
True. This is
And,
only a
and
third of the market.
yeah, yeah, the bond market's enormous.
Mhm.
The other thing, if you're just reading the headlines in the bond market, it can get confusing because it's saying bond market at all-time lows and
Mhm.
15-year, 17-year lows. And that sounds scary, but that also means we're getting better yields than we've gotten in 17 years because of the
Right.
inverse relationship to yields and the price of bonds.
Mhm.
Yields that we haven't seen in 17 years. And yes, inflation was high, has come down to about where it was a year ago. But there's a lot of opportunity in the bond market and something we're taking very seriously. And as you see our trades roll out, you'll see some of the adjustments we're making there.
Yeah, it's really wild to be active in the bond market like we are and see a Wall Street Journal article that says the bond market sell off. And I'm looking at the pricing in the market. I go, what sell off? Like where are we, and prices change. There are things you got to talk about, but at the end of the day, we hear all the time, is this the time I buy a CD? It's paying 5%. And it's like, well, CDs aren't the only form of fixed income. There are bonds that, different kinds of bonds. There's, all kinds of savings vehicles. So this is a really interesting time to be active in the bond market because there's a lot of great opportunity to lock in yield for a long time beyond just your typical bank CD that you think of.
Yeah. And we've never tried to we've never tried to time the bottom of a stock market.
Nope.
And we don't try to time the bottom of a bond market. We have really clear mandates for our clients. And those mandates are target returns for them. And we have to make our allocation adjusted to that in concert with or in coordination with what their risk tolerance is, how much they can risk. So all of this is to say we wanted to add a little bit more depth and meaning to some of the headlines that we're seeing out there. We love when people come to us with these comments because we can understand kind of better some of the questions that we have and we can address them. And they're all great questions. They're all great comments. And it's not to say, well, we know the answer, but it is important for us to tell you how to talk about how we're seeing it, how we view it, our worldview, our market view, and the way that we're actively managing to adjust it. So that's really what this was about. And your charts helped illustrate it. So thank you. Is there anything else you want to add?
No, I'm happy. I got to plug NASCAR. It's one of my sneaky hobbies.
Next time I expect a hat.
All right. I actually have a Daytona or no, Indy 500 hat at my house. I'll bring it.
Yeah, please do.
Awesome.
Great. So this is our monthly video. Hopefully we'll get it out before everything changes. But yeah, and look forward to hearing from you all. So please send us a note or pick up the phone and we'll be calling you too. So have a great weekend. We'll talk soon.
All right. Bye, Brandon.
Later.